Mr. Agarwal, good morning. Thank you so much for speaking with us. First up, tell us what is your export exposure and how worried you are about these increases coming as far as export levies is concerned on steel. What will it do to your prices?
Hi, good morning. First of all, related to our export, I would like to say that we export around 16% to 17% of our revenue earning comes from the export business. And if you see in out of your export portfolio, the export duty which has been imposed is in the tune of around 10 to 15%. So 80-85% of our export business is not affected on the export levy side. But definitely, when we are talking from the pellet side, we will see pellet is also one of the product which we export, and there is going to be a pressure of oversupply in the market. And the margins are going to be affected for some time. And apart from that, if you see, Shyam Metallic has always been a very, very different company. I'd been mentioning like they're in the multiple products of, specialty alloys, billets, sponge iron, and, aluminiums. So in one of the sector, yes, pellet is affected. And maybe, for a time being, maybe we will see that the margins in the raw materials will be affected, but later on, once we see the ease out on the raw material prices, the margins will also be, improving in the time to come, because long product is one business where we have a major contribution, and it doesn't have a very strong export overall comparison to the flat product. Like we all know that around 11-12 million ton of export minimum on the flat product business is being conducted from our country. So yes, but the effect is definitely going to be there on the sentiment part, and since the inflation is also increasing, the buying is also little bit on the slower side. But seeing a long-term, mid-term prospect and all, this is what I have to say.
Well, yes, point taken, Mr. Agarwal, and the fact that you have a very diversified portfolio will augur well during these tough times. But could you help us quantify the impact? What could be the margin impact, and what is your expectation how prices will correct in the domestic markets?
As on date, not a very good question for me to answer, but yes, there will be some impact, because immediately any decision on the restriction imposition of the supply side is going to affect the price side. I would say it will be, I see a correction of around, maybe around 4 to 5% in the time to come on the pricing side, because there has already been the correction in this quarter, and I don't see any correction going beyond that. But yes, in the time to come, it will also be, it will become normal.
Mr. Agarwal, hi there. Good morning. I know that you're hoping that over time things will become normal, but for now it looks like the markets as well are punishing a lot of the companies within the metal sector on the back of this duty rejig. What is the outlook when it comes to realizations? Do you think that increased demand due to lower prices now will compensate for the decline that we'll see in realizations?
See, we are more concerned about the margins. As a manufacturing company, we are all concerned about the margins. And if you see from the demand prospect, domestic demands are, like when we see from the construction side, when we see from the infrastructure side, we are seeing that the demand is increasing. And when we are seeing in the other sector also, the white hot goods and other, flat products, auto sectors and all, everywhere we are seeing the business is doing fairly well. So this is just a temporary phase, maybe we'll see some corrections on the pricing from as it has come up from the very spontaneous policy. But in the time to come, the pressure has to ease out on the raw material. So maybe one quarter and all, maybe a little bit soft, but in the time to come, when we see on the mid-term and long-term, we don't have that kind of supply on the metal space from our country, and the kind of demand, what we are seeing, the growth, what we are seeing, it's something we have to be very positive on. Thank you.
Right. So, Mr. Agarwal, you said that the export component is 16 to 17%. So, just wanted to understand for better clarity from your perspective as to what happens now with deals that have already been signed and what's the future of some of the deals that were in the pipeline?
See, our major contribution on the export is on the specialty alloy and the billets and all. So, we have a very, on the export, where we have a duty impact, we have a very low contribution. So I don't think it should going to majorly impact us. But yes, maybe a very little portion of around less than 1%. So as Shyam Metallic, we are not really bothered from this impact of any kind of an export commitment on the duty side.
Mr. Agarwal, but just for the industry point of view, how worse off would India now be placed versus other countries in terms of the prices? Given the fact that there is a supply crunch which is present globally, do you think despite the levy, there will be a good export demand nonetheless?
See, as a country, we are growing, so we are not very prominently dependent on the big export market. But yes, definitely, metal is being, more or less, it is globally driven prices and all. It do impact and affect the Indian market. But from the supply and demand, India as a country, we should not be very much bothered because, we are growing with our growth rate is very good, and steel we are seeing is also increasing a demand. But yes, maybe in the time to come, when we see that there is globally the shortage, because this shortage of steel, what is going from India has to be matched with the price. So maybe the global price increase. And with the geopolitical issue which is going on with the neighboring countries, so India will always be a darling country for everyone to look for. So maybe this is a very temporary phase, and in the time to come, I think this is all going to be substantiated with the raw material pricing and all.
Okay, Mr. Agarwal, on that optimistic note, we'll let you go. Thank you so much for joining us this morning. But let's continue the discussion with Mr. Rakesh Arora, founder at goindiastocks.com. Rakesh, hi, morning. Do you see that the corrections that we are seeing on the counters anywhere between 10 to 20% is an overreaction?
No, I don't think so. It is an overreaction. The duties which have been imposed are pretty harsh. And while India was exporting around 20 million ton of steel, the net imports would be slightly lower because probably there were some imports also happening. But 20 million ton, when your domestic demand is around 100 million ton, that's a big number to absorb domestically. So if you look at our export prices, it is around $820, and our domestic price is around 69,000. So they are on par. Now, if I have to absorb this 20% of production in-house, the domestic prices have to actually go down. So this reduction would be, in the tune of 10,000 to 15,000 rupees per ton. So what we are seeing is only, an initial reaction. But I think the industry get derated much more significantly and should be underperforming for quite some time.
Rakesh, hi, morning. So with the imposition of this export duty, could you just break it down for us in terms of the entire sector, how profitability from exports are likely to take a beating, in terms of how bad could the impact be?
Okay, so see, the first impact is on iron ore. Iron ore duty has been increased from 30% to 50%. So I believe that iron ore prices would correct by around 1,500 rupees per ton from current level. So that will be the export parity price. So this is because iron ore was already taxed at around 30% export duty. So there's an incremental 20% which has come in. The impact on steel is larger. I'm expecting that steel prices should correct around 8,000 to 10,000 rupees per ton from the current levels of 69,000. And steel margins for integrated players who have captive iron ore and coal should correct by around 8,000 to 9,000 rupees per ton. Whereas for non-integrated guys who are buying iron ore, they have an advantage because iron ore prices will come down. So for them, the margin compression will be 7,000. So now you can calculate, what will be the impact on individual companies. So just to give an example, if Tata Steel was making 24,000 rupees per ton in India, their impact is 9,000 to 10,000 rupees per ton. So this is our calculations. What actually will happen, we have to wait and see whether companies are able to hold on to domestic price or not, and till what impact is there on of reduced exports. This is all wait and watch, but my guess is that we will see severe compression on the margins.
Do you think that, though, Rakesh, that the impact of this could partially at least be offset by the potential lower domestic iron ore prices and the removal of the import duty on coking coal?
So as I said that, steel price drop would be around 10,000 rupees. That is what I'm expecting. The benefit of iron ore and coking coal put together is around 3,000 rupees. So the net negative impact is around 7,000 according to my calculations.
Rakesh, you began by saying that the reaction that we are seeing on the counters is not an overreaction. You're expecting significant derating going forward. So what should an investor do? Should they look at booking their profits or losses at this point of time, or would you suggest them to hold on?
No. Bottom fishing is totally has to be avoided. When we're talking about margin reduction of say 7,000 or so, some of the companies are doing only 9,000, 10,000. So that's a total, those companies can be loss making also at the expected margins. So I don't think bottom fishing is, a recommended, it's a good idea at this level. I think investors should book their profits, stay away, and let the sector stabilize before we, try to see, where the value is emerging.
Rakesh, I might be looking a little ahead, and I know none of us would have clarity on that, but given the kind of reaction you're expecting when it comes to the domestic prices, as well as the impact that these companies can face, do you expect there is some sort of possibility that the government might relook at this or try and find a middle ground?
See, everything is possible, but the thing is that if government is going to meddle with duty structures in such a big way, investor confidence into this sector is going to reduce dramatically. Nobody likes uncertainty. So I think these stocks become no touch for some period of time till there's clarity on the policy.
Certainty is something that the stock markets do not like at all. So as the suggestion is coming in from Rakesh as well, perhaps wait for the sector to stabilize and then nimble into these counters. We let you go on that note, Rakesh. Thank you so much for joining us and giving us your perspective regarding the entire metal space.